some of the competing exchanges are launching a product, I don't know, every week, every 2 weeks. There are some things that really take off. And there are other things that exist for a select few participants, and they're there, and they maybe they trade a few hundred contracts a day, but they're not really like accessible for most people. Maybe they're designed for a specific institutional purpose, but when it comes to new participants getting to market, I think you kind of want to narrow your scope a little bit. You're not going to be trading regional electricity futures, or you're not going to be trading
God forbid
500 ESG. I mean, there are just so many out there, and I think what we put together here at the Small Exchange covers a lot of the base case, kind of what you would need to get up and running, trying futures for the first time, with products that cover cryptocurrencies, interest rates, commodities like foreign exchange, oil, and precious metals. And I think that covers most of the majors. What's the weirdest futures contract you've heard of, Pete? Something that maybe drew your interest but seemed
you know what? The electricity futures are fascinating because they're all over the place, and the way it works, it's very regional, very illiquid. Probably the wildest thing I traded were called BTPs. They were Italian 10-year government bonds. And there's German government debt that's very liquid. The market looks a lot like our treasury markets in the US in terms of liquidities, hundreds if not thousands of contracts in a one tick wide market. The Italian government bonds, huge beta, big players in there. You'd see 1,000, 2,000 lots go through, but then the book would be, a 2 lot, a 3 lot, and a 1 lot on the bid, and the same thing on the offer. So it was probably you get used to, and I don't want to say we're spoiled, but you get very used to seeing a liquidity profile in whatever you trade that is pretty robust. When you lose that, number one, you engage in a lot of friction or slippage, which is not very good. You also get a discomfort in, okay, what is the true level and where can I manage? So I would say the Italian government bonds were probably one of the few things that not a lot of guys I knew traded. So it was an interesting, wild market, but something that, you talk about a learning curve. I was like, boy, these are moving a lot. And I decided, because I was trading German debt, let's add these. Well, I should have probably looked a little bit better before I started slinging them like I was the balloon. So you live and learn. I think the takeaway here is smaller products. And the reason I looked at reason I looked at BTPs, the Italian debt, was the European debt I was trading was relatively quiet and muted. I was looking for something with more movement. Where do I move? Well, I moved to the extreme. But what we want to do in our world here with the list of this products is we want to feel comfortable moving to another asset class that is moving without feeling like, oh my God, I have no scope or understanding around the movement of it or the construct of liquidity.
Yeah, and you mentioned liquidity there. I think that's probably the number one filter when deciding not whether a market is easy or hard to trade. I don't think that's really the right question to ask, but where do you start? I think liquidity is probably the number one piece. And then the next natural criteria for me is size. When you're gauging any market to trade, you need to consider how much you have in your portfolio. I mean, if you're an institutional bank over in Italy, you're probably trading those government debt bonds. But if you're an individual, it's tough to be trading in institutionally sized products. And this may look a little overwhelming, but if we just walk through it real quick here, it's each of the 10 products from the small exchange, their notional size. This is how much you're controlling when you buy or sell this product. And for small exchange, it's always just that current trading price times 100 is going to give you the notional value. And then also the margin to actually trade that product. How much is being taken out of your trading account to gain this exposure? And in addition to liquidity, I think size is probably the next metric that I would look to when gauging a new market to trade. And again, not easy or difficult, but just suitable for your portfolio, I guess, or within your reach. And the smallest one on here is the 2-year interest rate future from small exchange, $430 in notional exposure with a margin of just $88. Right. So pretty user-friendly in that sense. Not saying easy to trade, like, oh, it always goes up, just buy it, or it always goes down, just sell it. Right. But just getting exposure is more accessible, I guess. And that's what I associate with ease in this presentation.
Absolutely. So ease is a number of different things. It's a comfortable size. It is liquidity. It also is something that moves. And it's interesting. So you look at institutional futures, and a big crude contract is 7,700. A NASDAQ future, a micro NASDAQ is $17,000. I'm sorry, a mini NASDAQ, not a micro, $17,000 in margin. So huge. Is there anything in the world of institutional futures? There are Eurodollar futures, which are huge in terms of the liquidity, have margins, sitting anywhere between $175 and $300. Here's the rub with that, though. It moves 4 ticks in a day. Sometimes it moves more, but as a trader, there is no way you can make money in a market that only has 4 unique price points during a day. No one can buy that low and then sell the 4 tick. Nobody's that clairvoyant. So what we need is enough unique price points to give us tradable opportunity, which is, there's your opportunity. The easy part is the sizing and the access, and then liquidity. So you've really walked through it wonderfully here, Mike. And this leads to, how do I move from product to product, and how do I understand that? I'm curious, because I get asked this all the time. Is margin an indicator of movement? Is this my guidepost as to what I should suggest for product? And we know margin's dynamic. It can move. It's a function of volatility and movement of the underlying. How do you look at margin when you decide, is this product too big for me or moves too much?
Yeah, it's a great question, and something we can talk about right here is, like, you look at the U.S. dollar futures from small exchange, $14,800 in notional, with a margin of 176. It's being margined less than an arguably smaller product right below it. Small precious metals, $7,300 in notional, but $550 to trade. So the volatility is going to be kind of considered in this margin requirement. And the clearinghouse backing the small exchange, the OCC, sets that margin, and they consider things like the notional size and how much the product moves. And I like to pair the margin actually with how much the product moves. Yes. And you talk about the scalping ranges and the opportunity, and this fits exactly into whether a product is not only accessible, but like beginner friendly.
Right.
And here we're kind of just looking at the final step, which is, what is the scalping range? What is the number of unique ticks? It may be cheaper to trade Eurodollars, but if it's only moving 4 ticks a day, that's a pretty tough trade. I mean, you have to be an expert who understands the rate market or the macro environment and make a medium to longer term play. Maybe you buy a lot of contracts hoping for a big move. But if you're trying to get your feet wet in futures and try this back and forth price action that speculators love, this is kind of the guidepost that I would lean on, which is the one standard deviation daily move in each of these futures products. And you can see that the buying power requirement is related to this movement. I mean, dollars were larger in notional size, but they also move a lot less in precious metals. So when choosing a product, this is another very important consideration, where oil is going to move a lot more in terms of P&L in your account than 2-year interest rates are. And the margin reflects that as well.
You're absolutely right. So is margin margin is a guidepost, but not a Bible, so to speak, in terms of what to expect. So it gives you a sense of a ballpark around movement. But I think what you guys deliver, you and Frankie, in terms of that, putting a statistical backing behind what's a normal day, what's a 1 standard deviation day, what is this 2 standard deviation day, what is an outside day, so to speak. Those are powerful tools that speak to movement in the clearest way possible. And, community members get that every Monday. It's probably one of the most powerful pieces of research I've seen, because when you move from product to product, the one thing I was missing was scope like that. All right, what's normal, what's abnormal, and where should I expect? Should I be looking to scalp this market for 30 ticks when it's got a 120 tick range? That's very hard to do unless you're at those bounds of 120. Without that information, it's kind of a little bit of a guessing game. So as much as new traders think, like, I can go into a market like crude that moves $1.25. Now, I only want to risk 10 ticks or $10. You're going to find in a market that moves that much, picking the right $10 spot is going to be very hard to do. There's a lot of noise, a lot of unique price prints back and forth. So I will go back down if I'm willing to risk That's my comfort level is $10. I'm going to look to find a product that moves 15 ticks, 20 ticks, 25 ticks, because that's a reasonable expectation of trading that range, not, a buck and a quarter, which is $125 in the small universe. So, movement here is a great indicator of comfort. And if you're not comfortable with a certain amount of movement, you'll find that it's going to be very difficult not to become emotional and you're taking away mechanical. Then that's problematic for static delta trades.
Yeah, I think there are a lot of folks out there, and I have some pretty good friends in this space who look at a larger futures contract and how much it moves on a daily basis. Say it moves $1,000 a day, and their objective is to pull just $30 or $50 out of that contract. That's going to happen really fast.
Yeah.
And if it moves against you, you better have your stop losses tight, because otherwise it can run away and be $200 down in your portfolio. I think a more viable solution is to consider a smaller moving product. And the great thing is that you can scale up.
Right.
So if you're looking at a product, it's moving $100 a day, you want to take $50 out of it, you can just add a few contracts. I wouldn't say start at this point. I think it's important to get a feel for how that underlying is going to move. Luckily, we made the contract spec super easy. You don't have to spend time studying multipliers and what ticks equate to. I remember spending a lot of time studying that stuff and realizing it wasn't really ever going to help my trading. It was just like base case. Right. So luckily at Small's expiration, third Friday of the month, always ticking in a 1 cent increment that equates to $1. All that stuff makes it very easy to traverse these markets and consider the more important numbers, which are the daily standard deviations and how much your P&L is actually going to fluctuate depending on how many contracts you have. So you can always get bigger, but starting small, I think, is a good place to start.
Absolutely. Leverage is capital efficiency. Access to the market is important. Tax treatment of futures is better than the way they treat equities or ETFs. So there's so many benefits to futures. All those efficiency pieces don't work for you if you're uncomfortable in the market you're in. If you are, the movement doesn't fit what you're comfortable with. So think about that. And if you do, you will move from the Swiss franc pit to the D-Mark pit and find that market where you can learn and grow, because we all need time. That's the trader's greatest enemy, is they trade too big, they trade too large a product, and they don't have enough time. They run out of money before they have time to learn. So Small's mission was to give you time, give you an experience, give you diversification, give you that opportunity to engage a product in a way that gives you time to grow and understand it. So great piece of context here, Mike, because it's really important to, what's cool, what's trading is always interesting to follow, but if it doesn't fit, we find the products that fit and we grow into them. So it was a wonderful piece. Thanks so much for having me on.
Yeah, absolutely. Sometimes nice to take a high level look and remember, why we kind of got here. And if I remember correctly, Pete, you started in the D-Mark pit, which was small at the time.
Yes.
But by the time you were kind of done, it was one of the larger trading pits at the exchange. So pretty cool how it kind of comes full circle there.
It does.
That's going to do it for us today on Small Stakes. We'll be back in just a moment for Splash into Futures. Thank you so much, everybody, for tuning in, and we'll see you soon.